So thank you very much. I am Antoine Bouët, I'm director of CEPII. I have the pleasure to chair these new sessions of the Club du CEPII. The sessions will be in English and in French. The presentations will be in English. So the IMF just released the new World Economic Outlook, and so we took this opportunity to have the pleasure to hear two economists from the IMF Research Department, Mehdi, Benatiya, Andaloussi, and Andrea, Presbitero. They are going to present two chapters from the WEO, chapter 1 and chapter 4. Maybe we'll have some discussions about chapter 3 also. So Mehdi, Benatiya, Andaloussi is an economist in the World Economic Outlook divisions of the IMF Research Department. So he works on applied macroeconomics and energy and natural and resource economics. He had positions in the various area departments of the IMF, but also at the National Bureau of Economic Research and also at the World Bank. And he completed his PhD from Columbia University just after a master's degree from the École de Mines de Paris. Andrea Presbitero, who is an economist in the research departments of the IMF, is also a CEPR research fellow in the International Macroeconomics and Finance program, and is also associate fellow at Johns Hopkins University. So he works, he's an applied economist whose research covers financial intermediations, development finance, and international finance. So thank you for coming in Paris, presenting these 2 or 3 chapters of the World Economic Outlook released on April 2023. I would like to thank Jérôme Héricourt because Jérôme has accepted to discuss the presentations of the World Economic Outlook. So Jérôme is a scientific advisor at CEPII, and he works with the work program International Macroeconomics and Finance, and is also a professor of economics at University d'Evry and University of Paris-Saclay, where he teaches macroeconomics, financial macroeconomics and econometrics. So what we are going to do is to hear both presentations by Mehdi and Andrea on chapter 1 of the WEO, which is Global Prospects and Policies, and chapter 4, which is Geoeconomic Fragmentations and Foreign Direct Investments. I would like to say that to mention the beautiful title of the World Economic Outlook, A Rocky Recovery. So I hope that you are going to explain to us what is a rocky recovery. So I think, Mehdi, you start. So it's both interventions is for 35 minutes. Then we'll have the discussions by Jérôme for 15 minutes and 20 minutes of Q&A session.
Antoine, et merci beaucoup au CEPII de nous recevoir aujourd'hui. Je vais passer à l'anglais pour aussi accommoder mes collègues. So thank you so much for having us today. This is a real pleasure to be in Paris and to present the World Economic Outlook, which was published during the spring meetings about 2 weeks ago. I will cover chapter 1, which presents our global prospects and policies. It really draws from work from across the fund, from country teams to specialized economists, and I'm really happy to present it today here at CEPII. I want to start with an overview slide to give you the key messages of the chapter. Last time we did projections was in January of this year, in 2023. And at the time, we were anticipating that 2023 would be the year of turning points, with growth bottoming out and inflation coming down. I think it's fair to say that this is still our baseline scenario today. This is what the two charts on the left picture. On the turning to the growth chart on the very left, our baseline scenario is the red line. We now project that growth would be at 2.8% this year, increasing to 3% in 2024 and 2025. What has changed since January is the level of uncertainty. It has come up in the aftermath of financial sector stress that we've seen in the US and in Europe. And this can be depicted here on the left-hand side with the very large confidence bands that you can see in blue, with the darker blue, the highest probability events, and the lighter shades of blue, lower probability events. To give you a sense, we estimate that there is a 70% chance that growth could land anywhere between 1 and 3.8%, so that's a quite large uncertainty. The second takeaway is that risks are firmly to the downside. This can be seen on the left-hand side with the larger blue area below the red line. And there is, for instance, a 20% probability that growth could be at 2% globally this year, which only happened 5 times since 1970. Turning to inflation, we anticipate that headline inflation will go down in the next few years, but will remain elevated up until 2025. There are upside risks to headline inflation in 2023, with a 15% chance that headline inflation could be as high in 2023 as it was in 2022. The rest of the presentation will focus on the key forces underlying our forecasts. I will go into a bit more details on our forecasts themselves and discuss the risks around a baseline scenario and the policy priorities. So turning to recent developments. We started the year with a strong pickup in activity that could be seen in high-frequency indicators such as the service business activity PMIs or the manufacturing output PMIs, as you can see on the slide. And for both indicators, we were in an expansionary territory across the globe. It was true in advanced economies, in the NDEs, and really across countries. Confidence remained depressed, but activity was picking up. We've seen inflation starting to decline, but remaining high. That was certainly true for headline inflation that started to decline at the end of 2022 and earlier this year, both in the US and the euro area and across economies. Partly that was driven by the lower commodity prices globally that helped headline inflation go down. When you strip out measures of inflation, when you strip out from this measure of inflation the price of commodities such as food or energy, and you look at core inflation, indeed core inflation remained stickier than that's what you can see on the right-hand side, and that was true across countries again. Here, labor market tightness was something that surprised on the upside, in particular in the US, where unemployment rates were at their lowest in decades, when new vacancies were particularly high. We haven't seen signs of a wage price spiral as of now, where wages would accelerate, pushing up prices of goods and services and continuing to push inflation up. Indeed, nominal wages grew much less strongly and much less faster than nominal prices and we saw actually a decline in real wages in advanced economies. That suggests that going forward, as we see some pickup and some normalization in real wages, that will continue to pressure core inflation in the next few months. A major force that is shaping up the outlook is the forceful and synchronous monetary policy tightening that we've seen across economies. It's been much more rapid, much stronger, and much more synchronous than in past episodes of monetary policy tightening, as you can see on the left-hand side. And this has helped keep inflation expectations anchored. That's what you can see on the right-hand side, and that's true in advanced economies, low-income countries, and emerging markets alike. What this strong and forceful monetary policy tightening has revealed is that vulnerabilities had been building inconspicuously in pockets of the banking sector in the US and in Europe amid very low interest rates over the past decades. And with the failure of two regional banks in the US last month, that triggered a large drop in equity prices in advanced economies, particularly so for bank stocks, as you can see on the left-hand side. That has revealed that both investors but also depositors were very sensitive to news. Turning to the right-hand side graph, we had seen actually earlier this year a repricing of market-implied US policy rate expectations in markets. Earlier this year, in January, as you can see in blue, markets were pricing milder and lower interest rate hikes than what had been communicated by the Fed, and that's the dotted black line. And before the SVB failure, as of March 8th of this year, we had seen an upward repricing of the policy path that markets anticipated, and that was in the face of stickier inflation and new inflation prints that had surprised markets on the upside. And after the failure of the two regional banks later in March, there was again a repricing to the downside, and that speaks to the volatility in markets and the difficulty for central banks to communicate their intended policy rate path. Another major force shaping up the outlook is the elevated level of public debt. Public debt to GDP ratios, as pictured on the left-hand side, have been rising for most of the past decades, and particularly so during the pandemic, where forceful actions by governments led to large deficits and an increase in public debt. We also project that debt will continue to rise in the next 3 to 4 years and reach 100% of GDP by the end of the forecast period. At the same time, borrowing costs have remained elevated, particularly so for emerging markets that have seen sovereign spreads go up in the summer of 2022 and moderate but remaining elevated since. And the last and important force shaping up our outlook is the successful and sudden reopening of the China's economy after COVID lockdowns. And when looking at high-frequency indicators such as mobility, retail sales volumes, or planned international flights, as on the left-hand side, we can see that economic activity is back to normal in China. And this will have positive spillover effects across the globe, as China absorbs a large share of exports from trading countries. For example, it absorbs 25% of total exports from East Asia and Pacific region. So with these forces shaping up the recent developments, let me now dive in to our projections for 2023 and the following years. Our projections rely on assumptions that we make on the policy path for monetary policy and for fiscal policy. We assume now that monetary policy rates in the euro area and in the US will be higher and higher for longer than we had projected in past WIOs, and here we compare it with our October 2022 WIO vintage. At the same time, we assume that fiscal policy and fiscal support will gradually be withdrawn over the forecast period. Our baseline scenario also assumes that financial stress will remain contained thanks to forceful action of authorities, as we've seen last month playing out in Europe and the US. And with these assumptions, we forecast growth to be globally at 2.8% in 2023. It's a downgrade compared to our previous forecast, and here we compare it with the latest forecast that we had done in January 2022 before Russia's invasion of Ukraine. And the downgrade is really across the board, but most significant for advanced economies that are now anticipated to grow by only 1.3% in 2023 compared to above 2 and around 2.5% in our previous forecasts. Growth in emerging markets will remain stronger, albeit slower than in our previous forecasts. And the downgrade in advanced economies can also be seen in our current forecast for unemployment that we see will pick up in the next few years across advanced economies, as you can see on the right-hand side. Turning to inflation, we've revised our projections upward across the board, and that's both true for headline and core inflation. Headline inflation globally was above 8% in 2022 and will remain elevated around 7% in 2023, but will go down across the next few years. Core inflation will, in our projections, remain stickier higher and stickier than our previous forecasts, and will only go back globally in most economies to target by 2025, which is also an upward revision compared to our previous forecasts. Given the high level of uncertainty surrounding our baseline forecasts, the WIO this time also presents a plausible alternative scenario in which financial stress in vulnerable banks is higher than in our baseline scenario, but remain contained to vulnerable banks. In this plausible alternative scenario, we assume that this would lead to more cautious bank lending in advanced economies, with a contraction in credit by about 2%, which is about a tenth of what happened during the Great Financial Crisis. With policies reacting endogenously to prices and growth in the model, this would lead to a lower world growth world GDP growth in 2023 by about 2.5% in 2023 compared to our baseline scenario of 2.8%. Most of the downgrade in this plausible alternative scenario would be felt in advanced economies with limited contagion to emerging markets and China. Another key takeaways of our WEO report this time around is the medium-term forecasts. We project GDP growth up to 5 years ahead of time. This means that for 2023 we project up until 2028. And this round, our 5 year ahead forecast is the lowest that we've published in decades. In 2010, our forecast was for growth to reach above 4.5% by 2015. And today, our forecast for 2028 is below or around 3%. And there are several reasons for this low medium-term forecast. The first reason is that some major emerging markets have grown fast in the past few years and have reached a large size that is harder to continue to grow, and that's true for China certainly, and that's also true for other emerging markets such as South Korea. But other forces are also weighing on the medium-term outlook. We're anticipating slower labor force growth with population aging in advanced economies, but also in China. We are anticipating that geoeconomic fragmentation will weigh on the outlook for the medium-term horizon, and that a slower pace of structural reforms will continue to weigh on low productivity globally. Excuse me. Risks around our baseline scenario are firmly tilted to the downside. There's a risk that severe tightening in global financial conditions could materialize amid monetary policy tightening and potential stress in the financial sector. Monetary policy tightening could have a sharper impact on activity as debt, and that's true also for private debt, remain elevated, and as monetary policy has been fast and synchronous, which is quite unprecedented. Inflation could remain sticky and stickier than in our baseline scenario, which could lead to further or longer monetary policy tightening with adverse effects on growth. There's a risk of systemic sovereign debt distress in emerging markets. Today, about 60% of low-income countries are at a high risk of debt distress or already in debt distress. Growth in China could falter. There could be an escalation in the war in Ukraine with ripple effects on food and energy prices. And there could be further geoeconomic fragmentation, which could weigh on both growth and inflation. So as you can see, risks firmly tilted to the downside. We have in the past WEOs also highlighted upside risks that are of less relevance in this current round. And two of them are that consumption could prove to be more resilient, as there are still some buffers and some saving buffers for households. And we still see a narrow path for labor markets to ease without a pickup in a large pickup in unemployment. And given the downside risks and the numerous downside risks that we see around our baseline, the WEO this time around also proposes a severe alternative scenario where risks would materialize that would lead to severe tightening in global financial conditions. in that scenario, we assume that credit would contract by 4% in 2023, which is twice as large a contraction as what we see in the plausible alternative scenario, and about a fifth of what happened during the global financial crisis. Added to this tighter credit conditions, we assume in this scenario that equity prices would fall by about 10% on impact in 2023, that would trigger a flight to safety and a US dollar appreciation of about 10%, and a fall in confidence that would see precautionary savings pick up in 2023. Again, with policy, both monetary and fiscal, responding endogenously to growth and inflation, this scenario would see a fall of GDP growth by 1.8% compared to our baseline, which means that we would reach in 2023, in this adverse scenario, only 1% of global GDP growth, which is a low, particularly low GDP growth for the world. We estimate that there's a 15% probability that this level of growth could be reached in 2023, which is relatively low. Looking at the different channels on the right-hand side, the world economy would be impacted by tighter conditions which account for 0.5 of the downgrade, equally by the drop in equity prices and in confidence. And what's new compared also to the plausible alternative scenario is that the dollar appreciation in this scenario would also weigh on the outlook for emerging markets. So here's a slide that summarizes our policy priorities as we communicated them during the spring meetings. The first priority is the fight against inflation. We've seen that inflation has remained sticky and stickier than anticipated, and continuing to either tighten monetary policy or keeping a tight stance for longer until inflation goes back down is the priority. And given the uncertainty around our star, we advocate for continuing to communicating clearly central bank's objectives for inflation, but also their reaction function in case financial sector stress was to emerge again. If threats to financial sector became systemic, there would be at this point room for tightening pause or easing, and that would be in the severe alternative scenario, to which we're still quite far. The second policy priority is fiscal policy normalization, which would help in the fight against inflation and would also help governments restore debt sustainability and the buffers that might be needed if further shocks materialize in the horizon. We advocate for continuing support to households, but to target it better to only vulnerable households. One policy recommendation is also to continue to monitor financial risks in banks, non-bank financial institutions, and the real estate sector, where vulnerabilities could have been building. Coordination is one key area in which we see policy could help, in particular for debt resolution frameworks, or for the immediate lifting of trade barriers on food and fertilizers. There's also room for more coordinated actions around climate policy and in particular avoiding green protectionism. With this, I'll stop and thank you for your attention. Thank you.
Thank you, Mehdi. Andrea, you have the floor.
Okay, thank you very much. Also, I'm also very happy to be here and present one of the analytical chapter of the World Economic Outlook. And this is about geoeconomic fragmentation, and we look at the foreign direct investment. So I think it's probably one of the best places where we were looking for sort of getting feedbacks and present. So this is, as a quick introduction, is a part of a larger analytical agenda that we have at the IMF on geoeconomic fragmentation. So we issued at the beginning of the year a staff discussion note where we try to sort of lay out the channels through which we think that geopolitical tensions can affect the global economy, and so we sort of clearly, like, people think about trade as the first approximation, then capital flows, including FDI and non-FDI flows, migration flows, the international monetary system, and so on and so forth. So after that, like, we've been asked by our board to sort of do more work on this topic, and this is one of the first output that we have in which we zoom in on one specific aspect, which is foreign direct investment. Chapter 3 of the Global Financial Stability Report, which has also been issued a couple of weeks ago, maybe 3 weeks ago, is a sort of a companion paper in which they look at geoeconomic fragmentation, non-FDI flows, therefore cross-border bank lending and portfolio flows. And then there are like working papers already and other pieces on sort of trade, technological decoupling, and more will be done. And next October World Economic Outlook will look at fragmentation and commodity prices and commodities. So the motivation for this audience is probably quite not needed. So one aspect on the left-hand side is the idea of globalization from Paul Antras and co-authors. And here what we want to just point out is that if you look at FDI with some caveats about measurement issues, still FDI has been declining, or this sort of, they stopped increasing after the global financial crisis. On the right-hand side, instead, we want to showcase a couple of issues. First of all, there is this sort of big increase, a sharp increase in geoeconomic risks, which is the blue dashed line from Caldara and Iacoviello. You can find many other indicators of geopolitical risk, and all tell you the same picture, that after COVID, and clearly even more so after the Russian invasion of Ukraine, risks are increased dramatically. The other aspect, which is even more relevant for what we do, is that there is a large interest in sort of reshoring and friendshoring of foreign investment, both on the policy side and on the corporate side. On the policy side, there is a lot of interest. Think about what Janet Yellen said like a year ago, where she clearly called for U.S. companies to friendshore a lot of foreign investment to trust countries and allies. She delivered a very similar and probably stronger speech a few days back. Last week. Similar position has been taken in Europe, in France, and many other countries, including Asia. If you look at what's happening on the corporate side, like the red line show a measure of how companies are at least interested in reshoring and friendshoring. Here it's very difficult to observe any sort of an account measure of how actually in practice they're doing, although there are surveys in some countries. Here we simply look at and count in earning call reports how frequently they mention reshoring, friendshoring, and similar sort of words. And again, the red line tells you that this is clearly been increasing. It started after the trade tension between the US and China. It increased with COVID, and supply chain pressure increased even more with the sort of need to build resilience in response to the war. So what we do in the chapter, the first thing is we want to try to see like if there is something in the data apart from people discussing about these issues. And clearly it's difficult to, as I said, we don't observe. It's difficult to have measure of like actually firms moving investment back. What we look at the flow of new investment all around the globe. So we use the data from FDI market, which is about like 300,000 greenfield foreign direct investment since 2003 until December 2022. And we try, first of all, to plot a few sort of stochastic facts, and then we sort of build the analysis more and more so to try to see if geopolitical factors matter. On the left-hand side is pure descriptive evidence of what has been happening on flows in FDI in strategic sector, where strategic sector think about semiconductor, pharma, rare earth mineral, and similars. And the chart showed that there is evidence of at least regionalization of flows. So flows have been much more resilient through the, sort of the recent sort of crisis phases. In Europe and the US, has been much less resilient in Asia, and within Asia even more so in China, especially recently. Clearly, a lot of factors could be behind these trends. In the chapter, we look at specific sectors like semiconductors, and you can see that the divergence across countries is much sharper. On the right-hand side, we zoom in on only US outward FDI, and then we look at US investment into selected large economies, large recipients in the Americas and in Asia. And then we plot those countries depending on how much they gained or lost in relative terms if you compare like the period post-pandemic and the period before the pandemic. An interesting thing that you can see here is if you look at the country on the left, which are basically countries that in relative terms gain some sort of market share, so gaining or losing less FDI than the global average, those countries tend to be generally like closer to the US in sort of political and geopolitical sort of preferences and alignment. You can think about Costa Rica, Colombia, Singapore, Canada. On the right-hand side, instead, most of the countries sort of lost even more than the average, and those countries instead are sort of farther away in terms of geopolitics from the US. Yeah, think about China, Philippines, and Vietnam, for instance. So this sort of hints at the idea that geopolitical factors may matter for the allocation of FDI. So what we see on the left-hand side, which is some evidence of regionalization, could actually hint and show that there are factors behind that. And in this slide tells you that one of the key results that we have in the chapter is that at least we can show quite convincingly that FDI are increasingly directed to countries which are geopolitically close among each other. On the left-hand side is again a chart which is purely descriptive. What we do here is that we look at the share of FDI which are going to countries which are geopolitically close among each other. So the way we do that is that for each of the countries, we can compute the distance from the US in terms of geopolitical alliances, and we use one of the many variations of how countries vote in the UN General Assembly. So the similar the voting pattern is, the closer they are in terms of geopolitical preferences. So we rank those countries as close as they are to the US, and then we group all the countries on the bilateral flows, and we compute the share of FDI which are going to countries which are geopolitically close among themselves. Believe me, I cannot go into detail, but the point of the chart is that if geopolitical factors were not to matter, then the blue line should be around 20%. What we see instead is the blue line is about 40%, and what is more interesting is that the share of FDI going to politically close countries has been increasing sharply over time, and it went now above 52%. Clearly, I don't have to explain it here, but geographical distance matters a lot for capital flows. We do the same exercise, looking at geographical distance among countries, and again, we see that clearly geography seems to matter, but you don't see that, for instance, it matters less, first of all, and second of all, you don't see the acceleration that you've seen for geopolitical distance. Again, this is purely descriptive. On the right-hand side, what we do, we run a standard gravity model for our measure of bilateral FDI. We use count data, then we also look at values with all the caveat of values data. And we see a couple of results. The first of all is that on average we find this negative correlation, meaning that if countries are farther away geopolitically, then FDI are lower. And this is economically relevant. So if we compare the distance between countries which are somewhat geopolitically close, like France and the UK, with the distance between countries which are farther apart, like France and India, then we see that the decline in FDI is about 17%. So it's economically large. This sort of correlation is much stronger if we look at FDI that involve emerging market and development economies, which is relatively straightforward. It's been increasing over time, even if it's not shown here, and it's larger if you look at strategic sector versus non-strategic sector, which again is sort of supporting the idea that geopolitical things matters, because strategic sector are exactly the one we should be targeted by policies aimed at reshoring and friendshoring. So this basically suggests, if you believe these numbers, that if we had to move in an even more fragmented world, then there would be even a sort of further splintering of investment across blocks and of countries and aligned in one block or the others. So given that, we want to think about trying to come up with a measure that tells us something about how countries can be exposed or vulnerable to policies directed at relocate FDI. So I don't have the time to go into the methodology, but here the intuition is that we want to build an index of vulnerability to FDI relocation along three important dimensions. The first one is the geopolitical dimension. The idea, very simple, is that if a country is a stock of FDI that relies a lot on investment coming from countries which are geopolitically distant, so basically enemies, to keep it simple, then those countries will clearly be more vulnerable to reshoring and friendshoring. The second dimension is a measure of market power, which is somewhat should help countries be less vulnerable. And the idea is that if a country has a lot of FDI in sectors in which it has a lot of market power, meaning it's a sort of a top of the world exporter, then it's somewhat insulated, because for multinational it would be quite difficult to go abroad and find alternative location where to produce. And the final dimension is a strategic component, with the idea again being that if a country has a lot of FDI in strategic sector, it will be more vulnerable to a relocation, because those investments are exactly those which are the target of policies aimed at reshoring. So if you compute this index, which goes from 0 to 1, and 1 being particularly vulnerable, the chart on the right tells you two things. First of all, emerging markets are generally much more vulnerable than advanced economies, and this is true basically across the board. It's not an issue of like only China or India or a few other countries, but most countries are especially vulnerable across the three dimensions. Advanced economy less, and therefore clearly Europe less than other regions. The second result is even within advanced economies, not all countries are somewhat safe and insulated from FDI relocation. Some countries, especially those with a lot of strategic FDI, think about Germany and the Netherlands, for instance, are more vulnerable than others. So because of that, we look at which could be the cost if you go of FDI fragmentation if we had to move in a world in which there is this fragmentation that we are seeing now, and this scenario becomes even more relevant. And again, if you heard about the recent speech, for instance, by Christine Lagarde, was exactly in the direction of depicting a world which is more fragmented than the one it is now. So maybe in the interest of time, I will be very quick here. So we have a part in the chapter in which we kind of revisit the very wide literature on FDI spillover, in which I think some people in the room are for sure an institution have contributed to. We want to just show a couple of things. One is that this correlation between FDI and growth is generally driven by countries which rely a lot on vertical FDI. Think about like multinational and enter a country to produce inputs that then are used to those affiliates. These are exactly the kind of investment which are the target of friendshoring and reshoring policy. So again, that's a small piece of evidence that tells us that if we go to fragmentation, then we can actually think that there could be sort of negative effects on host economies. On the right-hand side, we do at the firm level, so we match World Bank Enterprise Survey with our FDI data at the country sector year level, and we show that there are the entry of multinational has some sort of positive spillovers to domestic firms in the same sectors, meaning that firms become more competitive to react to the entry of multinationals. And also there are some positive spillovers in emerging markets for domestic suppliers that can actually benefit from the presence of multinational since the market becomes larger, and then they have sort of technological spillovers. Because of that, then we have a model. We want to sort of quantify the effect of fragmentation. Clearly, we can't do that empirically because we don't observe yet FDI fragmentation. So we built different hypothetical scenario in the DSG multi-region model. So we have a dynamic macro model with 8 regions, and then in that model we sort of divide the world in our sort of baseline hypothetical scenario in 2 blocks centered around the US and China, and sort of we simulate fragmentation as an increasing non-tariff barrier across blocks, and then we see what happens in the long term to output losses. So a little bit more in detail, the model has 8 regions, and that's basically a constraint of the model. We can do more than that. And the regions are listed in the table. So we have the United States, China, Europe, And then in Asia, we split like and other advanced economies, though we split Asia in two, between India, Indonesia, and Southeast Asia. And the reason being that we want a sort of a part of that world which is somewhat non-aligned, meaning it's close to both blocks, and one which is like instead closer to China. Then we look at Latin America and the rest of the world. The rest of the world is Gulf states, Russia, and Africa, and the small states that we can't place anywhere. The way we sort of have these 8 regions and we allocate the regions to the 2 blocks is data-driven. So we use again the data on how countries vote in the UN General Assembly, and depending on how close they are to either China or the US, we allocate the region, which is basically the average of the country in the region, either to the US bloc or the China bloc, or if they are equally close or distant to both blocks, they are non-aligned. So India, Indonesia, and Latin America regions are non-aligned. Intuitively, the US, Europe, and the advanced economies are with the US, China, Southeast Asia, and the rest of the world is with China. So this is our hypothetical scenario. Then in the chapter we construct, for instance, many other scenarios. We have a tripolar world in which Europe sort of decoupled from the US blocks. And then we also to play around with non-aligned, moving them to different blocks. The chart on the right tells the main sort of baseline results. And so, as I said, like fragmentation is an increase in non-tariff barrier in investment inputs between the 2 blocks. And this is as close as we can get to sort of model a reduction in FDI across blocks. Then the non-aligned countries instead, in this scenario, can still import investment inputs from both blocks. So they are open to everyone. What we find is that, and then on top of that, we also have sort of, apart from a channel which goes through lower investment, we have a channel that goes through a sort of productivity spillover, technological spillover that delivers a reduction in productivity. So on average, we find that in the long run, so in equilibrium, global GDP goes down by around 2%. This 2% is widely distributed and sort of unequally distributed across regions. And you can see like the Chinese bloc is hit the most, and within that bloc, Southeast Asia is the one who lose more, like global GDP in that area goes down by around 6-7%. And the reason is that the countries in that region have a lot of pre-existing ties and linkages in terms of FDI inflows with the opposite bloc. So the moment we increase barrier, we sever those linkages, then clearly those areas suffer the most. For the very same reason, if we look at the US bloc, the output losses are less, exactly because the countries in those regions generally import a lot of FDI within the same region. Non-aligned, in the baseline scenario, with perfect certainty, with those countries can remain non-aligned, don't basically lose. You can actually show that they benefit. One of the points in the chapter is that we think and we believe that remaining non-aligned is very complicated, and again, you can basically see that in any possible news every day on financial press. And so, if you think that it's very difficult to stay non-aligned, I'm done, and that if it's very difficult to stay non-aligned, then we assume that there is uncertainty about future alignment. And the way of modeling uncertainty is that there will be some sort of smaller but still similar barriers between the non-aligned and the opposite blocks. If you put those barriers, and again we have different scenarios in the chapter, what we see is that if you look at the red bars, then also non-aligned lose in terms of GDP losses. So to conclude, we have more on the model in the chapter. We can maybe come back on the discussion, but the bottom line of our simulation is that we have somewhat large losses from strategic decoupling, and this is a strong argument to sort of in defense of global integration and globalization at the time in which many governments are instead advocating for inward-looking policies. So we have a push for multilateralism. That's sort of, maybe one can say, somewhat naive conclusion. And so in a more realistic scenario in which we are in a more fragmented world, we have sort of two possible policies for countries and globally. Globally, we have some proposal outlined mostly in the staff discussion note of developing framework for international consultation. It could be WTO, IMF, G something. And the idea could be think about the proposed use of subsidies for reshoring and friendshoring. We think it's similar to trade. Country could at least sort of be in some forum and discuss and announce these policies to reduce uncertainty and promote transparency. On the country level, clearly some countries could reduce vulnerabilities, or even more so, becoming more attractive to FDI, given that would be an investment diversion, through a number of policies which are listed there, which are the sort of usual policies that international institutions recommend. What we are saying is those kind of policies are even more important now than in other periods. Thank you very much.
Thank you very much, Andrea. Jérôme, you have the floor for 10 to 15 minutes.
Oh. Okay. I do my best. Where is my... Okay. Thank you very much, Antoine, and Christophe also. Christophe Dester is not here today, for inviting me to discuss this very interesting report. I mean, as usual with W, it's very rich, full of stuff, full of very interesting insights. I'll be quick on these introductions. We all know what the two chapters are, which have been presented today, are about, because they've been brilliantly presented. I will also talk a bit about chapter 3, which is focused on how to handle soaring public debt, because it's also a very rich chapter with policy recommendations which deserve to be discussed, I believe. So yeah, I'm going to have some questions and comments on specific points of your chapters and policy recommendations. Yeah, so starting with chapter 1, this is, I mean, it reminds me that an academic economist how brave and various forecasting exercises can be. Okay, and last year, 2022, reminded us how difficult it could be. So that's the WHO April 2022 forecast. Okay, so I, highlighted two advanced countries and Russia. Okay, so strong recession forecasted for Russia, lasting until 2023. Then that's for July 2022, October 2022, and that's April 2023. Okay, so now no more recession in Russia anymore for 2023, and who is in recession? UK and Germany. So that's of course we all know why those revisions happened for the euro area countries. Okay, because we all needed some time to understand the extent of damages for European economies of the Russian the war in Ukraine, and that show. I mean, those forecasts show, in particular, how Germany was dependent on Russian energy. But the revisions for Russia, for me, they remain very intriguing because really everybody, Marguerite Zalimov was not the only one forecasting a very strong recession and a disaster for Russia. And then, at the end, we got a mild recession. I mean, 2% is much less than what was experienced during COVID. And we got positive growth in 2023, higher than Germany or UK, for example. So my question would be, what were the factors underlying Russian resiliency that had not been initially anticipated, and how can these factors impact current and future trends? Something which is not very much discussed in the report is about productivity dynamics, especially in the challenging outlook part. We know that productivity slowdown or even decrease has become an issue in several advanced economies since COVID. France, for example, or even before, okay? Productivity has been stagnated or even decreasing in UK since 2015-2016. So here we got something very important related to potential growth. So, I mean, have you thought about some implications? Is it a currently studied topic right now at the IMF? Which brings me to your recommendation for a restrictive stance for the monetary policy until there is tangible evidence that inflation is returning toward target. Yeah, but we know that restrictive monetary policy has negative impact on investment and capital allocation and productivity, as you reminded yourself in box 1 too. So is it a good idea to tighten further monetary policy for countries with productivity issues? The chapter, and for sure for very good reason, insights on the downside of rising interest rates for banks. Recent events illustrated that this downside, but the increased interest rates also have positive impacts on banks' margin and profitability. Okay, that's for example, this colleague from Moody's and Fredai's, okay, that higher rates, they have a structurally positive impact on banks' revenues through the net interest rate margin. You got higher return on liquidity, higher return on deposits at the central bank. So at the end, are we so sure the net effect of rising rates is going to be that negative over financial system? Yeah, that's minor stuff. I will skip that because we don't have that much time. So yeah, going now to chapter 3. Okay, so just to remind the conclusions because you didn't have time to present it. You review the chapter is very interesting. Okay, it reviews many approaches for consolidating medium-term public debt, and at the end, chapter ultimately advocates well-timed fiscal consolidation, but also debt restructuring in some cases. You also show that historically economic growth and inflation play an important role in reducing debt ratio, but the chapter discards inflation as the too costly solution, especially for central banks' credibility. Personally, I was a bit puzzled by those conclusions, especially by the preference given to well-timed fiscal consolidations. First, because the own figures you show that for the average primary balance consolidation, you can reduce up to 2.1 percentage points the debt ratio after 5 years. And I was just wondering, am I misinterpreting, or are those really small numbers? Okay, 2.1 percentage points when considering how big are debt ratios nowadays, especially for advanced economies. And suddenly, currently, whole high debt Eurozone economies, they are reducing public debt, for example, at a pace exceeding that required the existing fiscal rules, even France. Right? Even France. And that's at a pace quicker than what you can get with gradual fiscal consolidations, because the cost of debt, and that's thanks to inflation, of course. The public debt is reducing by itself because we got this large nominal growth GDP, and the cost of debt is negative in an inflationary context. Okay, we are even respecting, even France, shortly, but still we are doing it, the European rule, mentioning that we should, above 60%, we should reduce public debt by 1/20 of the gap between 60% and the actual debt over GDP ratio. So, and some reductions, so for France the reduction is modest, but for some countries, this is really impressive. Look at Greece, for example. For some countries, the COVID debt has already disappeared or is close to be erased. So, I'm not ignoring any of its other costs, but maybe inflation is not that a bad means to reduce excess public debt, especially nowadays. Real interest rates are rising across the world, for sure, but they remain for now very negative. That's factual. And by the way, to which extent, this rising interest rate is likely to last? Okay, all of us were obsessed with secular stagnation before, until 1 year or 2 years ago. Secular stagnation is linked to structural parameters, structural forces in the economy. Okay, abundance of savings worldwide and low investment opportunities. These forces, they have not suddenly disappeared. Secondly, the ideal fiscal consolidation is defined in the chapter as driven more by expenditure reductions than by revenue increases in advanced economy, and that's consistent with something you find is well-known works by Alesina, Favero, and Javazzi, for example. These approaches have been widely criticized. Okay, we know that fiscal consolidation is recessionary. Okay, whether based on spending cuts or tax increases. We know also that aggregate demand shocks can have very long-lasting effects. So just look at the GDP dynamics in the euro area after 2010, 2011. Okay, well-aligned fiscal consolidation everywhere, and we have the GDP has been removed from its long-run trend for 5 or 6 years, and I mean the thing is we never got back to our previous long-term GDP trend. We know that private investment also increases following rise in fiscal deficit, so where with the crowding out effect, so these are well-known criticism. There is another less-known channel which goes through income inequality. I would like to elaborate on in 1 minute. No worries about it. So first, We know that fiscal consolidation increases inequality, and this is that's something we know, for example, from two very interesting IMF working papers in 2013, and that we know especially that fiscal consolidation will increase inequality all the more than we got cuts in social spendings. We know that inequality increases household debt. Okay, we got a work by Puma, Francais, and others. We know that inequality explains between roughly 1/5 and 2/5 of the increase in household credit for 30 advanced countries between 1972 and 2017. We know that excess household leverage triggers financial crisis. That's well established since, in particular, works by Jordan, Schuller, and Taylor. And we know that financial crisis, they got huge short and long-run GDP costs. Okay, we know that financial crisis, they cost in terms of long-run GDP, which means financial crisis reduce permanently tax base. They require massive government interventions, costing additional dozens of additional GDP percentage points of public debt. So once again, for me, there is no such a thing as well-timed and well-tailored fiscal consolidation. And those ones here, targeted on spending, they got that, like any other fiscal consolidation, they bear their own risk of being self-defeating. Now moving to chapter 4, that's for me, I really like this chapter. Okay, this is among the three I read, this is the most research-oriented for sure. You've got several contributions with your index of countries, vulnerability to FDI relocations. These attempts to quantify the cost of FDI fragmentations, and then the counterfactual exercises are very, for the long-term economic implication of FDI fragmentation, they are very interesting. Also, so I got here only 2 or 3 very general comments. You said it in a way in your conclusion, Andrea, that ideally we would love all of us to preserve global integration through multilateral efforts, because this is the best way to reduce the GDP cost of the economic cost of FDI fragmentation. How do you achieve that in practice? Because a hard lesson we learned from the past years, and especially from the Trump administration, this is easy to hinder the functioning of multilateral institutions. You just, for the WTO, just prevent a few judges to be appointed, and that's it. So my question is, how do you prevent a single country from filibustering, even in the more realistic policy designs we imagine in the conclusion of the chapter? Firms and policymakers increasingly looking at strategies for moving production processes to trusted countries with aligned political preferences. I was just wondering, reading that fragment after COVID, some people, and even at CEPII, predicted or recommended a regionalization of supply chains as a way to limit issues by too far outsourcing, because we learned during COVID that it was sometimes bad to have, to be so related, to be so dependent on so far away countries. Okay, we know that the idea is that the farther, the higher the cost of supply chain disruptions. Okay, so my question was, could regionalization of supply chains be also an answer to geopolitical tensions? Because we know that, if we locate supply chains in nearby countries, there is a high chance that these nearby countries are also more politically aligned and have closer political preferences. The correlation is not 100% for sure, but there is a correlation. There is some interesting strategic consideration, or even strategic trade policy consideration, when the chapter emphasized that some countries may ultimately benefit from FDI fragmentation. Isn't it precisely what the US are trying to do with their IRA? And more generally, all economic incentives they are implementing to support production on the US territory. And it's a bit pessimistic, but in that case, for some other advanced economy, isn't the dominant strategy to try to do exactly the same? My last point is really a bit further away from economics. In regard to policies, a large and widespread economic costs from strategic decouples provide rationale for robust defense of global integration at a time when several actors are advocating more barriers and in more looking policies. That's perfectly true. from a pure economic point of view, but there are other reasons that purely economic from decoupling. Because there are some countries nowadays, do we really want to be that dependent on this kind of countries regarding supply chain processes? So again, this is a great and stimulating report, and yeah, I look forward to discussion.
Thank you very much, Jérôme. It was a very rich discussion, so I'm sure that Mehdi and Andrea would like to respond, but I cannot give you more than 5 minutes.
Okay. Okay, thank you very much, Jérôme. I will be quick for questions that you raised on Chapter 1. So what are the factors behind the upward revision to Russia GDP growth? So in 2022, Russia's economy contracted by 2.1%. To some extent, there was a floor put on the GDP fall in 2022. In particular, the favorable terms of trade that we've seen in 2022, and an unexpected and strong fiscal response by the Russian authorities, which led to strong GDP effects later in 2022, which are anticipated to have some carry-on effects in 2023. There's also in 2023 where growth is expected to reach 0.7% in Russia. There's also a base effect because we're starting from a lower level in 2022. Having said that, in the medium term, the projections still speak to a contraction of Russian economy. By 2027, it's now anticipated that Russia's economy will be 7% lower than it was in our projections pre-invasion. As for your second question, I will refer, so the question was about the productivity losses and what should monetary policy do in that context. We actually have a full chapter, chapter 2, the one that we haven't discussed today, dedicated to R star, the natural rate of interest, where we go at length at trying to estimate what R star is and where it's going, and in particular looking at the productivity TFP growth as a major factor for long-term R star, but also demographics. At the current juncture, however, our recommendation, and we have some catchwords on this in Chapter 1, is for central bank to navigate by the terrain, not by the stars. In particular, because inflation is high at the current juncture, and the recommendation here is to stay data dependent and act up until inflation is back to its on its way and firmly so to its target. For banks, the assessment in Europe in particular is that banks are healthy with strong capital and liquidity ratios at the current juncture. But as we've seen in the past month, vulnerabilities in the banking sector could affect market sentiments. We've seen loss of confidence in Credit Suisse, and there's high volatility that could ensue even if only corners of the banking sector could show some vulnerabilities. At the conjuncture also there's I think an advice to really focus on monitoring what happens in the real estate sector, and through this channel what could happen to the banking and non-bank financial institution in Europe and elsewhere.
So thank you also on my part. I think on Chapter 4 you touched upon like the 4 key issues definitely, and going backwards like quickly. Other reason for decoupling, yes, that's true. We don't enter into that. We don't discuss them. Our point is that there could be benefit from decoupling, which is from national security, for instance. our aim is like to try to do our best to quantify the cost of the fragmentation, then it's in the end of the policymaker to make choices. Clearly, measures like IRA and others, not necessarily only the US, could be the dominant strategy. That's true, and that seems to be the direction where we're going. Again, our answer to that would be, we show that not necessarily there are costs to that. There are clearly spillover costs and domestic costs. I would say it could be a little bit naive to think that countries will internalize spillovers, but they should at least internalize domestic costs. And pushing for the spillovers also like and then to answer your very first question. Clearly, yes, it's true, and then I said there's basically no response of how can we sort of try to sort of go into multilateralism, but at least having a discussion, at least I think it's the way to go. On regionalization, yes, I hear your point. It's true that the closer you are, the more allied you are. Again, it's true. But our allies today are not our allies tomorrow, and we have seen very recently. And so, regionalization, it could be good, but some countries very close to us, it could still be like, the point is that if you want to really be less vulnerable, we have to diversify as much as we can, and that's actually the outcome from last year's chapter. On the fiscal, so chapter 3, let me answer only your last point, where I think it's the most interesting sort of suggestion you provided, sort of going into sort of the inequality angle. I like it a lot, and to some extent goes in, and then you use that sort of to reiterate the fact that in the end of the day, like fiscal consolidation could be self-defeating through this inequality channel. I buy the inequality channel. I would also argue that inflation has a lot of distributional effect and increase inequality, and the fiscal monitor of April goes into that. But even without that, I guess there is a lot of literature on that. The other option you can have, which is restructuring, which is restructuring also sort of unequal burden of the restructuring, even within domestic. It could be like domestic saver if you default on your treasury on domestic bills, and it could be if you go through banks, then you have also effects on that. So that's just to say that it's not only fiscal contraction that leads to inequality, and on the fact that clearly that's its contraction, and you're right into that. But then what we show is that at least it seems to from the VAR tells you that the numerator like that goes down much more than GDP. So even taking into account to that, then there are effects on that to GDP. You're saying they're relatively small. Yes, it's true. I think what is important is going in the right direction. Some countries are going to that, like if you think of like market access and all that, and spreads. The moment that you have a turning point in that, I think things are better, and so that's what the direction country should go.
Thank you very much. I think that we can have some Q&A session for 5 to 10 minutes, but not more. So I would like to ask each people who want to ask questions to be very rapid. So Michel Aglietta wanted to ask a few questions. Michel?
Yes.
The questions can be in French or in English, as you want.
I like reading the GFSR. That is a companion paper of the WEU. And I agree that China-US rivalries lead to geopolitical fragmentation in the world economy, with the upsurge of systemic financial stress in the long run, especially in EMDs, emerging market and developing countries. So I agree with what has been said. But something very important has not been mentioned. That is a radical change that is underway in the international payment system, with the creation and expansion of central bank digital currencies, CBDCs. The BIS has shown that this principle, it is getting rid of the key currency principle, whereby the international reserve asset is the dollar, that is the counterpart of the debt of a single country. Because what is important is that the protocol of CBDCs allows them to control the flight of liquidity both ways. to and from foreign currencies. So it means that those protocols must be compatible to eschew chaotic IMS. To make them compatible, an ultimate international reserve currency is the best way. So two questions, and two questions only. Can the IMF help building adequate buffers and safety nets to mitigate sudden reallocation of cross-border capital flows? And the second, can it promote the SDR as the ultimate reserve asset to enhance the interoperability of the international payment system in becoming the international lender of last resort? It is my proposal in a book that will be published this year, entitled The Race to the Apex of Money. Thank you for listening.
Thank you very much, Michel. Dominique?
A small question. It's about the policy recommendations of the IMF in your report. You plead for a steady monetary policy, that is, no decline in interest rates, okay, by central banks, and then also in tightening of fiscal policy. Don't you think that these two recommendations may have an impact, negative impact on growth, on the overall, which is in contradiction with what I suppose all institutions and the IMF first expect, that is an increase in growth. So what is it the fact that we still have a negative real interest rates, which is your main reason for instance, pleading for a steady level of interest rates, or do you have other arguments?
Other questions?
Yes, please.
Yeah.
So, François Faure, BNP Paribas Economic Research. I have the same question than Jérôme Héricourt stated in its intervention. It's about productivity, because we are in the process of updating medium-term forecasts. So you showed a very huge impact on Southeast Asia, the impact of FDI. So did you take into account of this on potential growth? Because as far as I know, I'm not look at figures in detail, but as far as I remember, there is only one country for which potential growth has been revised down compared with before the crisis, which is India. It's 0.5, minus 0.5 in terms of potential growth. But the other one, it's between 0 and 0.5. So did you take into account the fact that FDI relocation will have a negative impact? And I have also, related to this, did you take into account the fact that for commodity exporters, you have, for some countries, you have an impact of commodity prices on potential growth through the production function. I don't know if you take this into account, but it's the way we take into account. And from now to 2026, at least if you smooth commodity prices, you should have a negative impact on potential growth. So my question is, did you revise or did you update it potential growth? I mean potential growth, not GDP level, which is obviously lower than it should have been if there would have not been a crisis over the last 2 years.
Mehdi and Andrea, these are very difficult questions, and you have only 2 minutes.
Yes, I think short, working backwards on, I guess, Southeast Asia, more can say maybe on some of the aspects, but just a clarification. So what we do there, the exercise is that we have this scenario in which FDI goes down, and then investment input goes down, and that has two effects. One is a capital effect, so there is less foreign capital, and the other one is a productivity effect. So the idea is that there are technological and knowledge transfers. And then clearly it's higher in Southeast Asia, and the two layers are one on top of each other, and now I don't have the number on top of my mind, but this productivity one is non-trivial. But that's sort of an exercise which is outside of the projection that he showed. So this is the results I've shown are mid-long term. We have some results for the medium term. We have all the sort of 1 year, 2 year. We have all the impulse response. I guess this is, enter what Mehdi presented as one of the several downside risks that we have. But then it's not that then they incorporate this sort of scenario into any of the scenario that they have. I guess the only thing that they do is this scenario of severe financial stress crisis. Monetary policy, fiscal policy, enjoy. And on the international monetary system, yes, I guess what I said, we have a research agenda, so the staff discussion note has some discussion about some of these issues, especially on the international monetary system and the role of CBDC. There's a lot of work on central bank digital currency. I guess if the question is more on safety nets and the role of the fund, I guess, for instance, like again, there is discussion like what has been shown like recently and the crisis before, the swap lines and all that clearly contributed to provide some sort of help for some of the countries to sort of counterbalance like cross-border capital flows. On the role of SDR, even though I personally looked into that in the past, I don't have like a clear sense of now where it's going. But I will check definitely the book.
So on monetary policy, so our line is in, you said that monetary policy to remain steady, and then we complement by saying steady but ready, meaning that steady to fight inflation that has been particularly high and surprised to the upside globally. We highlight a few examples in the past where monetary policy tightening had not been sufficient or long enough for inflation to go back down swiftly, and that had a cost for longer. And there's an example of the 80s in the U.S. Where easing monetary policy happened perhaps prematurely, leaving inflation higher for longer, and that's a cost that we see could be high if it's repeated this time again. In terms of why ready, steady but ready, if policy tightening leads to stronger impact, in particular if there are vulnerabilities in the financial sector that will arise along the way, and if the adverse scenario that I presented earlier were to materialize, then there would be some room for monetary policy easing. Up until now, we have been far away from this scenario, and thankfully, and thanks to the forceful actions by the authorities in the last episode of banking stress, and then we see that central banks can continue to separate their actions on inflation through monetary policy from their actions on banking sector and financial sector at large stability through the use and the deployment of financial stability sector, financial sector tools that they have. And I think I will stop here. Thank you.
Thank you very much. I think that we should stop right now. I would like to thank our guest speakers for this very rich and interesting presentation. Thank you.
Thank you very much.